Good morning, traders. Good morning, traders. It's 8:02 a.m. Chicago time on the 9th of November 2016, the day after the US election, as I'm sure you've heard. Um, Derivatives trading involves substantial risk of loss. It is not suitable for all investors. Past performance is not necessarily indicative of future results. This is another trader bite. It's hard to start this broadcast without making a comment about the political situation here in the US. However, this is not a political show, and the goal is not to discuss who's right, who's wrong. I don't really care. Um, the fact is, the market is neither Democratic nor Republican. So for those who were are disheartened by the results, you've got to get back to being a trader. And for those who are elated by the results, it's the same thing. We need to refocus on what drives the market and what the market is in the business of doing is pricing opportunity versus risk. That's all it is. It's a mechanism for pricing opportunity versus risk, and it does so by using a price as a way of discovering how much interest there is. It's a lot like every price is a politician and the volume is the number of votes it gets. Okay? And so as the market pushes lower or higher, it is simply investigating how much interest there is, much like an election. It's very hard to predict, much like this election is. The fact is, nobody knows what they're talking about. That's what's proven. So there's a shakeup underway in the U.S. as well as the political system in Europe, as we saw with Brexit, and I think that's a good thing. It's needed. It's not something investors welcome because the status quo is the strongest driving force for human beings. We don't like to be disrupted from our balance and our routine. However, investors don't know what to expect, and so they move to the sideline, and that's what causes the market to go limit down on 124 points of range, like it did yesterday. So whether you like Trump or not is really irrelevant to you as a trader. You need to get to this place as quickly as possible. This is much like a trade that worked out in your favor, and you got your full target in the form of Trump being elected, or a trade that took a full stop in the form of Clinton losing and conceding. It's about the very, very next thing you're going to do. So don't go out there and decide that uh, you know I'm gonna take a big position and risk my entire account. I was up till about 3:15 last night, Chicago time, watching the election and watching risk here at stage five. And I'm going to tell you that far too many people had to be liquidated because they just got in no stop and were hoping for the best, and they got in long. And it's very, very frustrating to watch that because it's unnecessary and it's not trading when that happens, and it's just in our nature to do that often. So um, this is the path ahead. It's that we are to take the information that we have. We take the market action that we saw last night, and we move forward with our best opportunities and push those trades, and then we monitor our risk and we take the losses when they come. If you are feeling a heartache for today after yesterday's election, it's nothing more than a trade that didn't work out. And we it's hard to judge what the political process will look like in the United States, with Republicans controlling the legislative and the executive branch, the White House and the U.S. Congress. I cannot judge it. I know what we get when they're deadlocked. I've been seeing it for years and years and years here as a U.S. citizen, but I can't judge it. All I can do is figure out where the opportunities are and take advantage of them. That's my job as a trader. That's almost a patriotic duty. This is what we do. We provide liquidity, and we allow the market to behave in a more muted way, in a more controlled way than if we didn't exist as traders, and it was just the higher time frame, the high time frame participants trading against each other. This is our job. Okay, so I'm not going to comment further on the election or politics. The fact is, there are controls and checks in place, and the election was driven by political rhetoric and a lot of reality TV style, um, propaganda. But that doesn't mean that that's what we'll get. So we just judge it for what it is as it happens, and we just move on as traders. Okay. So with that being said, there's nothing to review. Um, Based on yesterday's action, I did not put out any hypotheses yesterday because the expectation was for volatility. The market did push to the expected target, almost achieving it overnight. 121.53 even is the point of control for this entire area. Let me show you that here, sharing my screen. This is what we did last night. We went from 21.52.50 and we got lock limit down at 2028.50 at lock limit on the overnight session of 5%, just so everybody understands how this works. We are way off that low limit now, but in the extended trading hours ETH or Globex session, there's a 5% limit up or down from the prior day's settlement. And that's computed by the exchange, and it's available on their website, on the CME Group website, if that's the exchange you're on. When that limit is hit in the overnight session, there is no further limit. And what the system will not accept is selling below that limit, at below 28.50. And so what you end up with is an artificial floor, and it looks a lot like this. So it got down to this 28.50, and it just cannot move any lower. And so you end up with a tremendous amount of volume going off right at that low as people try to get out and others try to take the opportunity, knowing that this is the limit. However, the exchange has a discretion to reinstall a new limit if it wants. But what generally happens in the overnight session is it just does not take any offers below the 2028.50, and it continues to do so until the 8:30 open. In fact, there are provisions that allow the limit to be extended in very specific cases, but at the reopen, the lock limit down extends from 5% to 7% from the prior day's settlement. And once it extends to 7%, the market stops trading. The market then goes into a pre-opening netting phase where the bids and offers are matched with each other and a fair price is computed. The market triggers again and it opens with a new opening price. Then a 13% limit from settlement is put into effect, and then if that 13% limit is triggered, it goes into a halt, and it does the netting process again. I think they pause for about 10 minutes. It does the netting process again, and new opening price is determined, and then it opens again with a 20% limit. If the 20% limit is triggered, trading is closed for the day. So if you have a position on, you are stuck with it for the rest of the session. And so this is the process of limit down. And so the percentages are always from the prior day's settlement. The benchmark is the prior day's settlement. So this is the process of limit down, and in the overnight, the market does not halt. It simply does not take offers or sell orders below the limit down price. And that's what we got last night. We saw it push up against the low. You can see the point of control is right at the prior days, at the overnight low. And we've had a pretty big move, and we've pushed through the mid of that move. And so when we look at the overall picture of what we've done on a composite, here's what we've done. We have been stuck in this range since July. July 8th is the day I'm using for this composite here. We've been stuck in this range for quite some time. We started to sell off on the Clinton email stuff. We gapped up on the FBI stating that there wasn't much in those emails, amazingly. And then it rallied yesterday, and now we've pushed all the way down, way down here. We've pushed down to a major high volume node below. So what we did is we pushed all the way down to this key area below that we built earlier in the year and have stopped at 2028.50 right here. And we have bounced back up, and we are trading in this crevice that we see here, the CLVN, the composite low volume node that we've been battling for the last couple of days. The market is essentially coming back to where it's not quite where it was yesterday, but it's certainly coming back into balance. And it's very hard to predict what it's likely to do this morning. There's just no way for me to know what's likely to play out. So this morning is going to end up being just like yesterday, where there's the ability to decide what is likely to happen is very difficult. So I'm just looking at the bigger picture. I know that higher time frame participants are in place. I'm looking for 2153 as the key figure above. That is the balance area above. However, there's potentially, we don't know if Trump will be damaging to the economy. We know he has been damaging to the existing political system, which is not such a bad thing. Um, but we don't know how damaging that is to the economy, especially if he is going to hold true to his promises to dismantle a lot of these trade agreements and impose tariffs on China and all these things that he had talked about. It's time to see if the words are met with action or not. And of course, we don't know that until he forms his cabinet and gets into office in January of 2017 to start his term. So uncertainty ahead. The Christmas rally may be in jeopardy this year, the Santa Claus rally. But overall, it's hard to predict what it's likely to do this morning. We do have a gap below us, and we've got 2 days of pretty decent volume on top of us right here. These 2 days here show a pretty decent amount of volume with 2123.50 being the point of control of the last 2 days. I'm expecting that the market is likely to start drifting higher as it has digested or it continues to digest the news and the uncertainty that's in place. And then I suspect that it's likely to start turning down and into the gap zone below. The fact that we pushed as far as we did, and there was a tremendous amount of volume in it, uh, the fact that we pushed as far as we did in the overnight session, based on my experience, leads me to believe that we're likely to revisit those areas below. We're likely to start drifting down. So my bias is the intermediate term bias is to the downside. However, I don't trade off of an intermediate term bias. I simply look for setups that fulfill short-term trades in that direction. So don't take this as, hey, I should take a swing short because I'm not. That's not my ball game. It's not my expertise. I'm simply looking for intraday moves that have an advantage, a reward risk advantage. Okay, so I'm over my time already, but the expectation this morning is for the market to come back and attempt to go higher. I expect it to find resistance, and I expect for us to push down into the gap zone below to 2100. I'm looking for an attempt to bounce, and then I'm looking for this to start shifting down and pushing down towards the 2080 area. Oops, I stopped too early. The 2080 area, that is the key target below. That's my primary hypothesis today. This is what I'm looking for for this session. An initial push higher, open auction out of range, an initial push higher, and I'm looking for it to find resistance, late sellers into the news, and for it to rotate down. The market and the polls and everything else was indicating that Trump maintained a lead of at least 4% throughout, and they were completely wrong. The entire um, political guru media structure has failed everyone. They just don't know what the real pulse of the country is, and so the market has priced in a pop in the last couple of days, but now it's starting to rotate lower. Again, it's hard to imagine that we push a low in the overnight session in the U.S. markets just as we did yesterday, and we don't explore at least a good portion of it to the downside, and that's my intermediate term expectation. That's hypo 1. Hypo 2 is an attempt lower into the gap zone, pushing down, potentially closing a portion of the gap zone, and then I expect the market to go sideways and just drift sideways as we digest this information. This is the next most likely scenario. And then hypo 3 is an attempt to push down, and then the market starts to rebalance. The overnight inventory, the short inventory starts to push higher, and we start to get responsive back into yesterday's range, in which case the expected target is at 21.23 half. That's scenario number 3. Okay, so what does that mean? How do we trade that? We simply look for, we don't try to trade the first move. At least I don't try to trade the first move. I'm looking for how is the first move responded to? Is it impulsive? In other words, is it exaggerated? Is a strong push in one direction that brings in the opposing party, and then that creates the opportunity for me. I'm looking for how does the market react when the equities open, and does it see no resistance going in a specific direction? If so, I'm looking for pullbacks. If not, then I'm looking for the opposing force to step in and turn the market around for a push in the other direction. And then overall, I'm looking at these three hypos as for evidence as to where my targets are likely to be, what it's likely to do, and so on. So there's an entire video that I'm going to put out on how to use these hypos to actually execute your plan. I'll try to put that out as soon as I can. It needs to be cleaned up. But for now, that's what we have to work with. Again, just don't get stubborn with your risk. Please don't risk your entire account on one or two silly trades that did not work out. Trades are supposed to not work out a good portion of the time. There is no way for every trade for you to gather enough information to put on a trade that gives you a 100% probability. So don't defend a trade as if it should or has to work. There's no such thing in trading. It's an illusion to think that there's a way to predict the market in such a way that it will not cost you something. It has to cost you something. The market has an ebb and flow, and you're not likely to be in tune with it all the time. So sitting here and pushing your entire account value and betting it on one trade is nothing short of insane. Just look to use wider stops today. Volatility is expected to be higher. Rotations are expected to be in a 5 to 6 point range. That is second standard deviation of the normal rotation value. So you're going to have to trade smaller. You're going to have to use wider stops. And you're going to have to be quick with your losses today. Don't sit there with a deer in the headlight look, waiting for the market to come back and hoping and praying that you don't have to take a loss. Take the loss quickly and just take a breath, refocus, and look for what the market is actually telling you. And that's what we're here to trade, what the market's actually telling us. Good luck, and I wish you the best. Thanks.